Welcome to today's webcast, Suitability in Annuity Transactions, Updates to the Model Act and Impact on Market Regulation Exams. Before we begin, I'd like to cover a few housekeeping items. To receive a copy of today's presentation, please send a request to reply@riskreg.com. To ask a question during the meeting, type your inquiry into the Q&A panel to the right of your screen. We will respond to all questions after the session unless time permits at the end of the session. To answer polling questions, click on the radio button to the left of your desired response, then click Submit to record your response. For technical assistance, click on the Help widget at the bottom of your screen. Today's presentation will be recorded. CRE eligibility. Log into the webcast with your first and last name and email address. Remain on the webcast for a minimum of 50 minutes. Participate in the polling questions. 80% response required. To answer a polling question, click on the radio button to the left of your desired response, then click Submit to record your answer. You do not need to have the correct answer, but you must participate to receive credit. Complete the course participation survey. For attendees participating in a group, designate one proctor to log in as an individual on behalf of the group, then complete and submit the group sign-in form within 24 hours of the event's conclusion. The form can be downloaded from the resource list on the right of your screen. Complete and submit the course participation survey, which can be found in the resource list on the right of your screen. The form can be accessed from the resource list. One CRE credit will be issued to eligible participants within 30 days. RRC will not issue credit if all criteria are not met without exception. It is now my pleasure to turn the call over to Jennifer Kelly. Jennifer, the floor is yours.
Thank you. Our first presenter is Terry Harkenreiter. Terry has over 30 years of insurance industry experience, and she currently performs market regulation examinations and data calls on behalf of state insurance departments. Her key areas of expertise includes life and annuity, including suitability, health, title, and property and casualty. Our second presenter is Josh Gehring. Josh has approximately 20 years of insurance industry experience. He currently performs market regulation examinations on behalf of state insurance departments. His key areas of expertise includes life and annuity, including suitability, and he has significant experience conducting audits, investigations, and compliance oversight within the insurance industry, primarily focused on life and annuity companies. I'm now going to turn the presentation over to Terry, who's going to go over the course objectives. Terry?
Thank you, Jennifer. Today, Josh and I will provide insight on the recent changes to the Suitability Model Act and how those changes may impact our market conduct exams. We will begin with a brief history of the model and the purpose behind the best interest standard of conduct. We will review each of the 4 best interest obligations, which are care, disclosure, conflict of interest, and documentation. We will discuss the new requirements related to producer training and supervision. And finally, we will also talk about what we as examiners should be looking for during our examinations and also provide examples of red flags. Okay, before we get started, let's see who's on the call today. Which of the following most closely describes your current role? A, market regulation examiner. B, data analyst or specialist. C, actuary. Or D, other. Please click on the radio button to the left and then hit Submit. And I'll read the question again. Which of the following most closely describes your current role? A, market regulation examiner. B, data analyst or specialist. C, actuary. Or D, other. Okay, great. Thank you very much. It's always good to know who is out there. So let's continue. A brief history of the Act. The model was established in 2003 to ensure the financial needs and objectives of senior consumers were addressed during an annuity sale or replacement. And The 2000 Act was revised or expanded to also apply to consumers of all ages. In 2010, there were significant changes made to the Act. The 2010 version established a regulatory framework that held insurers responsible for ensuring that annuity transactions are suitable, whether or not the insurer contracted with a third party to supervise or monitor the recommendations that were made by during the marketing and sale of the annuities. It also required that producers be trained on the provisions of annuities in general and the specific products that they are selling. And then finally, where feasible and rational, the 2010 Act made these suitability standards consistent with the suitability standards imposed by the Financial Industry Regulatory Authority, or FINRA, for sales of variable annuities. Which brings us to 2020 and the best interest standard, which was approved by the NAIC in January. The purpose of this regulation is to require producers to act in the best interest of the consumer when making a recommendation of an annuity, and also to require insurers to establish and maintain a system to supervise recommendations so that the needs and objectives of the consumer at the time of the transaction are effectively addressed. In the context of the model, the term producer means a person or entity required to be licensed to sell, solicit, or negotiate insurance, including annuities. It also includes an insurer where no producer is involved. The 2020 model further harmonizes regulations that are enforced by various regulatory authorities. In other words, the model acknowledges that producers or insurers may be subject to comparable standards of another regulatory body, such as the SEC or FINRA, and the model includes similar or comparable requirements where applicable. The framework outlined in the 2020 model also requires producers and insurers to meet additional standards that exceed those required by the 2010 version, but does not rise to the level of a fiduciary standard. So since the model requires that producers act in the best interest of the consumer when making a recommendation, what is actually considered a recommendation? As defined by the 2020 model, a recommendation is advice provided by a producer to a consumer that was intended to result or does result in the purchase of an annuity. It does not include general communications to the public or educational information, prospectuses, or other product and sales materials that may also be provided to the consumer. Okay, now that we have provided a brief history of the model and defined what is and is not a recommendation, it's time to peel back the layers of the best interest standard. The 2020 model requires that a producer act in the best interest of the consumer under the circumstances known at the time the recommendation is made, without placing the producer or the insurer's financial interests ahead of the consumer's. To satisfy the best interest obligation, a producer or insurer must satisfy the 4 obligations which are outlined in the 2020 Act regarding care, disclosure, conflict of interest, and documentation. For those of you who have examined the suitability of an annuity sale based upon the 2010 or a prior version of the Act, some of what we'll be presenting will be familiar. However, the 2020 Act has established a clear framework of obligations, whether existing, revised, or new, that must be satisfied by both producers and insurers. Most importantly, and you will hear this repeated throughout this webinar, these obligations must be clearly demonstrated or documented by the producer and company. Now I'm going to turn it over to Josh to begin taking us through the 4 obligations.
Thanks, Terry. All right, guys, I know that under care, there's a lot of concern out there for treating, consumers and even those consumers in a senior market. We got to do the right thing. And products over time have become more and more sophisticated. And that's why we're just stressing the importance of how much the care really means. And so the updates to the Model Act provide additional details on how a producer must demonstrate care. What diligence do they need? What skill And what does all that mean when recommending the purchase of annuity? What does that really mean? The key thing that I like to stress on the phone call today is producers must collect sufficient information. Once again, they've got to collect sufficient information from the customer so they can understand what is the need, what is the financial situation, what are the financial objectives. Ultimately, what is the consumer trying to accomplish with this annuity? Additionally, producers must understand the options available to them so that what they can recommend to the consumer. In other words, producers should provide the consumer choices, give some options, and allow the consumer to think through, talk through those options and determine which one of those choices best suits their needs and objectives. Producers must also have a reasonable basis to believe the recommendation addresses the needs and financial objectives over the lifetime of the product. Not just at that one-time sale at the beginning. They need to have that long-term picture, look out over the course of the next 10, 15, 20 years, depending on the product. Again, this is key and should be clearly documented by the producer and included in the annuity files. Additionally, producers must communicate the basis of their recommendation. For example, let's say the producer is meeting with a customer and they're talking about needs and the consumer is saying, I really want my annuity to grow, I want the death benefit option, I want perhaps a lifetime income guarantee, some of the things that might be included and available for that producer to choose from. Those are the kind of things that should be clearly documented in the work papers. And oftentimes, companies require producers to fill out a suitability review form or something of that nature that's signed off by the producer as well as the consumer. Definitely a best practice and requirement of some way to keep that documentation intact. And then later on in this presentation, we're going to continue our discussion around the documentation of a suitability form. We've got an example of at least the initial page of one of our something we've seen before, and we'll cover that as we move on. And lastly, producers must have a reasonable basis to believe the consumer will benefit from certain features of the annuity. Those features could be tax-deferred growth. Maybe it's annuitization. Maybe they need immediate annuitization. Could be death or other living benefit riders that are available at that time. And really, care, what does it really mean? It means the recommended product benefits should clearly align with the consumer's needs and objectives. You're taking care of them. Hey, we're trying to sell this perhaps to a family member. We're taking care, and it's not just about the income. It's really about what is the need, what is the financial situation, and how can we solve that as a producer for that person. Moving on, as mentioned, we've got a lot of consumer profile information to gather along the way for a producer, and that is key so they can make that suitable recommendation. A producer must consider all that information in its entirety prior to making a recommendation. Now, keep in mind, every consumer situation is different. We all understand that companies have a wide variety of products that can be sold, different offerings, so there may not just be one obvious solution or recommendation to consider. However, what is key is that this type of information, as you can see on the slide here, a lot of different things that are talked about in the model, this is the type of information that must be collected. I'm going to go over a few today here. Obviously, don't have time to go over each one of these bullet points, but I will cover a few that we think are just great ones to talk about today on the call. One of them involves financial time horizon. For those familiar with annuities, we understand that annuities are designed to be a long-term accumulation product. And so the producer must understand, is the annuity appropriate given the consumer's age and future needs? The producer should be thinking about, will the consumer be able to access their funds without penalty, when they're ready to use them? Thinking about other things of collecting information around what assets do they have to understand, well, are they able to meet an emergency that might come up? What is their liquidity options? Producers must collect that type of information on the front end to understand what product to recommend. Does the consumer have enough income to meet their expenses? Great question. Well, how do you know that? You got to collect the information. You got to understand their monthly income. You got to understand their monthly expenses. Think about as a consumer might be approaching retirement. How will their income change maybe in the next 5 years? Will that have any effect on the annuity? And are they able to meet or afford to tie up more of their funds? Risk tolerance. I think all of us on the phone call today probably have different risk tolerances. Some are very risk averse. Some are able to withstand a little more risk. And so we know that fixed and indexed annuities generally protect principal and credited earnings from market risk, but we know that these products offer interest rates, indexed return rates that are often higher or lower than what we talk about, that a producer talks about at the time of sale. And so we're collecting that information, understand what risk, what's their tolerance is key to understand what type of product is best suited for the person and demonstrating that care. Another key thing is just the consumer's prior financial experience. Have they done anything with annuities in the past? What is their financial? Have they done mutual funds? Have they been heavily invested in a stock market? What is their prior financial experience with annuities or other financial products? All right, moving on to the next slide. One of the things that another area and a key consideration that the model talks about, and we think is extremely important under care, relates to annuity replacements. In cases where a producer is recommending the consumer replace an existing annuity or replace a life or product with annuity, it's key that the documentation is very, very thorough. And I know from Terry and I's work on examinations, our experience working for insurance carriers where we were part of, annuity replacements were always an area of additional scrutiny, and especially by regulators. I know for those on the phone today, I've been part of a company fielding in when I was at an insurance carrier. Questions came in around, well, how is this in the best interest? How does this make sense for the consumer? And again, that's what care is all about. So some of those key suitability considerations specific to replacement scenarios are listed on here. Again, we didn't list everything, but some of the ones that we think would be most valuable as a takeaway. So I'll cover a few of these right now. How about surrender charges? Will there be surrender charges or penalties incurred by replacing the product? Again, we need to capture that information as a producer. What riders or other benefits will be lost by replacing? Again, this is critical. Maybe even they had riders or benefits prior in their existing product. Maybe they're not relevant anymore. Again, that's good information to capture so we understand the producer can recommend the right product. How does the new policy put the client in a better position? Care is all about that. We need to understand that we're in a better position for the consumer. They have a tangible financial benefit as part of this transaction. One that we've had some concerns with, and we've seen a lot of regulator questions, comes up in complaints. Does the client understand that he or she may be starting a new surrender charge period by replacing the existing product or products? Again, capturing the information and making sure it's documented is key so the consumer understands what they're getting into. These are the type of questions, these are the type of information that must be considered and documented clearly. I guess I want to stress this. While replacements are not necessarily unsuitable, they do require a heightened level of review by the producer, by the insurance company, and of course by us as regulators. This is a key thing to make sure that the person is in a better position. And keep in mind that a pattern of replacements by a producer or history of replacements by the consumer may not be in the best interest. All right, everyone, thanks for sticking around. We are up to polling question number 2. We're ready for polling question number 2, so get ready. I'm going to read it. It's a true or false. The consumer's age is not an important factor to consider when assessing if the annuity recommendation meets the consumer's financial objectives. Once again, question polling 2 is the consumer's age is not an important factor to consider when assessing if the annuity recommendation meets the consumer's financial objectives. Again, select the radio button and hit submit. We're looking here to see how the responses are coming in. And we are ready to move on. I can click the button, sorry guys. Here we go. Excellent, guys. The answer is false. Age is an important factor. The age of the consumer can help us determine the type of annuity that might best fit for the consumer from a producer's perspective. Again, it might determine the type of annuity, whether it's deferred, perhaps they want to grow that balance over time. Maybe it's an older consumer that recently retired and an immediate income is needed to help drive some of that lost income from retirement. Well done, everybody on the phone. Let's move on. Okay. The next part of the obligation we're going to talk about relates to disclosure. It's important for consumers to understand that producers selling annuities are required to have an insurance license and that the producer is acting as an insurance agent. Producer must communicate to the consumer in what capacity he or she is acting and that the producer must have the required and appropriate licenses. The 2020 model sets forth additional disclosure requirements to assist producers and insurance companies in carrying out this obligation. Appendix A of the model includes a sample disclosure form that was developed to assist producers and companies to meet this requirement. The form provides the consumer with information on the scope and terms of the producer's relationship with the consumer and their role in the transaction. Let's move forward and take a look at Sample A that contains this information. All right, everyone, I know this slide could be small depending on what size computer screen you're looking at. It's definitely small for me. Again, we've already offered to provide the slides afterwards so you can take a look at this. And good news, it is included in the back of the model regulation as well at the end of the model reg. So this is something that can be available. I'll talk through it here just to make sure that you guys are clear on what is covered and as part of this sample that was provided. The first yellow arrow, number 1, talks about what is one of the requirements. And I guess before I even get into this, I do want to point out companies don't have to use this specific form. They may have a form they've already created or choose to create something in a different way. The key here is the information that must be disclosed, and that's what I'm going to talk about. So number 1, an affirmative statement on whether the producer is licensed and authorized to sell various products. So that box under number 1 includes items like, hey, I can sell the following products. Fixed annuities. It could be mutual funds, variable annuities, stocks, certificates of deposit. What are they available to sell? The second arrow on the bottom left talks about an affirmative statement describing the insurers that producers authorized to sell insurance products for. Is it one insurer? Could it be multiple insurers? That type of thing. The top right arrow, the third disclosure that isn't key here, is the description of the sources and types of cash and non-cash compensation to be received by the producer. Could be a one-time premium payment, or it could be an ongoing fee. And finally, the fourth arrow talks about a notice of the consumer's right to request additional information regarding cash compensation. That could include a reasonable estimate of the cash compensation to be received, such as a stated range of amount or percentages. Is this a one-time, a multiple occurrence, that type of deal. And again, some sort of range there, something that if the consumer wants to have more information to understand the payment or the compensation to be received by the producer, they can request that. Additionally, the disclosure obligation requires the producers disclose pertinent details of the proposed recommendation to the consumer. Now, I want to stress this is nothing new. Producers previously had to disclose this type of details to the consumer. However, since we had everyone on the call today, we wanted to remind everyone of just the importance of ensuring this type of information is adequately collected and documented by the producer and the company. So think about as you're reviewing annuity on an examination, or perhaps you're even considering purchasing annuity for yourself or a family member, these are the type of things to be on the lookout for as part of the disclosure obligation. So let me talk through a few of these. Potential surrender period or surrender charges, that's a big one. We've talked about that already. We've got information such as potential tax penalties that could be involved. Certain fees the company may charge, whether that's an expense fee, an annual fee, investment advisory fees. Disclosures around the potential charges for riders or other options on the annuity. What else are they paying for? Disclosures around limitations on interest or on interest returns. Disclosures around the non-guaranteed elements involved in annuity. Hey, we're guaranteeing a 1% rate of return, but recognizing that you might earn more. Those are the kind of things of the non-guaranteed elements that the producer should be disclosing and included in the file. And just market risk in general. To meet this disclosure obligation, many companies require producers to complete a suitability review form. And again, we're going to cover and share that as we continue the discussion around documentation, how critical it is as part of support the annuity. Let's move on. We are ready for polling question number 3. I know it was a quick hit from the prior polling question number 2. Here we go. You know the drill. I'm going to read it out loud again just to make sure those can hear it. Number 3, the disclosure obligation addresses all of the following except multiple choice. A, what products the producer is authorized to sell. B, whether the producer is part of a $1 million roundtable. C, description of the cash and non-cash compensation to be received by the producer. And D, whether the consumer has been informed of potential surrender charges. Again, select your answer and hit submit. I'll read it one last time. Polling question number 3, the disclosure obligation addresses all the following except A, what products the producer is authorized to sell. B, whether the producer is part of the $1 million roundtable. C, description of the cash and non-cash compensation to be received. And D, whether the consumer has been informed of potential surrender charges. All right, answers are in. We are ready to move forward. Let's see how everyone did. Excellent job. The correct answer here is B, whether the producer is part of a $1 million roundtable. All the other options are key disclosures, such as what products they're authorized to sell, the cash and non-cash compensation available, and if the consumer has been informed of potential surrender charges. All right, thanks for sticking with us so far. I know some of this material can be a little heavy, a little dry at times. We do have some time here at the end to really talk about some of those information around how to apply this on an examination, so thanks for sticking with us. Appreciate it. So moving on to conflict of interest. So the third obligation relates to conflict of interest. I'm sure many, if not all of you, are familiar with what a conflict of interest is based on a personal or professional experience. The Model Act defines it as a financial interest that a reasonable person believes would influence the decision of the producer. These type of situations must be avoided, managed, and disclosed by the producer. Again, this is an area where we don't see a lot of issues with conflict of interest. There could be a situation where perhaps an insurance agent may be acting also as an attorney for the customer, or maybe there's a personal loan involved. These are the type of situations that they don't come up too often. However, we thought the next slide, as Terry and I had put this presentation together, we thought and brainstormed around what is one area that we have seen more frequently regarding conflict of interest, and that area relates to when an insurance producer is also licensed as an investment advisor or financial advisor. These situations require the producer to adhere to both the requirements of the insurance side as well as the security side of the law. And again, documentation, I can't stress enough, and disclosure is critical here so the consumer completely understands what role that producer is acting in. Is it an insurance agent? Is it an investment advisor? Could it be both, depending on the situation? Again, this is an area that we see as you're reviewing forms or reviewing files at a carrier or doing an examination. This is one that we definitely have seen before and think could come up more frequently than other things we've seen. So to wrap up conflict of interest, at the end of the day, the producers must have a reasonable basis without any impairment to believe that their recommendation effectively addresses the consumer's financial situation, their insurance needs, and their objectives. I'm going to turn it back over to Terry, and she's going to walk us through some of the documentation area, because this is just an area that we enjoy, we're passionate about, and I think it really is the key to the area. So Terry?
Thanks, Josh. Yes, this is my favorite obligation, the documentation obligation. It's where the rubber hits the road. Basically, everything must be documented, and if it's not documented, then it didn't happen. There are three scenarios which can occur. As Josh has mentioned up until this point, I think you've heard over and over again, it must be documented, it must be documented. It is very key. There are three scenarios which can occur during the sale or solicitation of an annuity product, all of which must be adequately documented. The first is where the consumer agrees with the producer's recommendation and purchases the annuity. The second is where the consumer refuses to provide their profile information and then purchases the annuity. And finally, in the third situation, the consumer chooses to purchase an annuity that is not recommended by the producer. Now we're going to walk through each of these scenarios and the documentation that we would generally see. In the first scenario, the producer must include a written record and basis for their recommendation. This requirement is often achieved through the completion of a suitability form that is signed by both the producer and consumer and submitted along with the annuity application to the company for review. As a best practice, in the case of a replacement transaction, some companies have developed and require a standalone replacement comparison form to be completed in order to assist the producers in documenting the basis for the recommendation. These companies also require that the comparison form be submitted along with the annuity application. We have also seen instances where replacement comparison information is baked into the suitability form itself. Regardless of what an insurance company requires, producers must clearly demonstrate the basis for their recommendation, and the file itself should stand on its own. We've included the first page of a sample suitability form, not to review in detail, but to discuss generally. Based on our experience, each insurer usually develops its own suitability form to assist the producers in gathering a consumer's profile information and to also ensure that key requirements of the model are addressed. However, the level of detail and amount of information required to be provided on the form may vary from one company to another. Sometimes this is due to the products being offered. In other instances, this may be due to corporate culture or the company's understanding of industry best practices. I want to make a couple comments about the suitability form. Depending upon the content of a company's form, in some instances, simply completing the form may or may not be enough for a producer or insurer to demonstrate care. For example, the form may include general questions about a replacement, such as, is the proposed annuity replacing an existing annuity? What is the reason for the replacement? Or is the consumer aware that there may be surrender charges when terminating the existing annuity? Another company's form may include those questions along with the following. What is the actual amount of the surrender charge? What % of the cash value is the surrender charge? For example, is it 1%, 2%, or 10%? How long has the existing annuity been in force? There's a big difference between knowing there could be a charge, as in what one company may ask for, and whether the charge is 1% or 10% of the cash value of the existing annuity. Something to consider. Some companies also require that producers provide not only this information, but also a comparison between the existing and proposed annuity, along with a narrative explaining how the replacement will ultimately benefit the consumer. As an example, we've seen instances where the reason for replacement on the suitability form was identified as guaranteed income and interest rate, which sounds fantastic, sign me up. But there was nothing in the new business file that supported that statement or how the new annuity was better for the client. As I said earlier, the file should stand on its own, and if material or key information is not provided, then we as examiners should follow up with the company to see if they've conducted any follow-up with the producer and to request documentation to support any additional information that was considered as part of the suitability review process. Additional information may be provided by the company, such as case notes or emails or call logs, to support the additional work that the company did in gathering information. All right, everyone. The second scenario involves a situation where the consumer refuses to provide any or some of the necessary consumer profile information. In these situations, the producer must fill out a form similar to what is identified as Appendix B of the model. The form includes an acknowledgement by the consumer that they have refused to provide some or all of the information to help the producer determine if the annuity effectively meets the needs of the consumer. The form also advises the consumer that they may lose protections under the insurance code of their state if they sign the form or provide inaccurate information. Typically, we see this as a one-off situation. However, companies should have procedures in place to track customer refusals to identify a pattern of potential sales practices issues. We'll be discussing this later in the supervision section of the presentation. In scenario 3, this is when the consumer is purchasing an annuity that was not recommended by the producer. In these situations, the producer and consumer must complete a form similar to what is identified as Appendix C, and which we've included on the slide as well, of the model, to acknowledge that the annuity transaction is not based upon the recommendation of the producer. And as Josh had mentioned previously, these forms are included as appendices and can be standalone forms, but companies can also bake these into their suitability as well. Polling question number 4. The Model Act requires producers to document which of the following situations. A consumer refuses to provide the consumer profile information. B, a written record of any recommendation and basis for that recommendation. C, consumer selected an annuity that was not recommended by the producer. Or D, all of the above. Again, select the best answer and hit submit, and I'll repeat the question. The Model Act requires producers to document which of the following situations. Consumer refuses to provide the consumer profile information. A written record of any recommendation and basis for that recommendation. Consumer selected an annuity that was not recommended by the producer. Or D, all of the above. Okay, it's tallying. Let's see what we've got. D, all of the above, is the correct answer. All 3 of these instances must be documented by the producer. Okay, before moving on to the new requirements set forth in the model related to training and supervision, I wanted to take a moment to quickly recap the 4 best interest obligations. First, we have the care obligation. Who is the consumer and what do they need? What are their objectives? It's the gathering of the consumer's profile information and ensuring that the recommendation meets the consumer's needs and objectives. The second obligation is the disclosure obligation. It's about the producer. What compensation will the producer receive related to the sale? What products is the producer authorized to sell? How many other companies is the producer appointed to do business with? This obligation is about providing key information about the producer to the consumer. For example, are they recommending the only product that they are authorized to sell? Something to be considered. Third is the conflict of interest obligation. Again, this is all about the producer. Is there any material information about the producer which may be a conflict and potentially influence the producer's recommendation? And finally is the documentation obligation, which we just finished discussing, where the rubber hits the road. Documentation must support the basis for the recommendation or the consumer's refusal to provide information or the consumer's decision to purchase an annuity that was not recommended by the producer. So if you take anything away from this presentation, if it's not documented, it didn't happen. We're not clairvoyants or magicians or mind readers. So if it's not documented by the company or producer, it didn't happen. Okay, let's move on to training. The new model requires producers to be trained on the new requirements of the Act within 6 months of the state's effective date for adopting the new model. This requirement applies to all producers, regardless of whether or not they've already completed the 4-credit course required by the 2010 model. Going forward, producers who have already completed the 4-credit course will be required to complete an additional one-time 1-credit training course on the appropriate sales practices, replacement, and disclosure requirements required by the 2020 model. New producers will be required to complete a 4-credit course, inclusive of these additional requirements prior to making any recommendation. As previously required, companies should have a way to track that producers have completed the required annuity training before issuing an annuity. A key provision of the 2010 model was the requirement for insurance companies to implement a supervision system. The 2010 version of the model requires that insurers provide effective training, transaction review, written procedures, and an annual report to senior management, among other things. The 2020 model builds upon what was required by the 2010 model and also requires insurers to also establish and maintain reasonable supervisory procedures in 3 additional areas. And the first area is that companies must assess whether the producer has provided the information required by the revised model. For example, an insurer may revise its good order procedures to include a review for the proper completion of the required disclosure forms. For example, Appendix A, B, or C. And also reject or pend any applications where information provided was incomplete or a required form was not provided. And the second area is companies must identify and address suspicious consumer refusals to provide consumer profile information. This may be accomplished in various ways. For example, a company may establish a process to monitor refusals at an agent or agency level and then follow up with sales management or producers with a higher than average rates of refusal. Companies may also require implement additional review criteria for business submitted by individuals with higher than average rates of refusal. Companies may also implement protocols to contact consumers to confirm their understanding of the transaction and also their refusal to provide their profile information. These are just ways a company may handle situations where suspicious consumer refusals are identified. And the third area is companies must identify and eliminate any sales contests, sales quotas, bonuses, and non-cash compensation that are based on the sales of specific annuities within a limited period of time. To clarify, this prohibition is intended to forbid short-term incentives designed to promote the sale of a specific product in a manner that creates pressure on agents to recommend annuities that may not be in the best interest of the client. For example, this provision would apply where a producer's eligibility for a particular bonus is tied to his or her sales of one particular annuity product during a particular month. However, the requirements of the model are not intended to prohibit general incentives regarding the sales of an insurance company's products where there is no emphasis on the sale of specific annuities within a limited period of time. And now I'm going to turn it back over to Josh to talk about red flags and what to look for in examinations. Josh?
Sure. Oh, there we go. Got the slide moving. So I know we just covered a lot of information, probably like the fire hose, just a lot of information, a lot of good information around this best interest standard and what to look out for as part on this in the annuity suitability model regulation. And we thought we wanted to spend a few minutes discussing what to look for on an examination, some of these red flags based on our industry and professional experience. And I know that both Terry and I have reviewed lots, probably hundreds or thousands of applications in our careers across examinations and working for insurance companies and different roles as the audit department and market conduct areas and consulting. And we've seen a lot across the year. And I'm guessing some of these will be familiar with some of you on the phone as well as part of your examinations. And again, since we've got a wide audience, we thought we'd share some of the examples that we thought would be red flags. And again, if one or more of these items is included in an annuity file, it does not necessarily mean that the annuity is not a good choice or is automatically unsuitable for the consumer. However, it does require that additional documentation in the file to have that explanation of why perhaps these things are included. I'll spend a few minutes on a couple of these. No written procedures. Both Terry and I have had situations when reviewing a company where we have either no written procedures or very minimal written suitability procedures. I mean, that's a red flag in and of itself. How can a company effectively demonstrate that it's supervising its producers if it doesn't develop and maintain adequate suitability review procedures? Just a big thing to look at. And keep in mind, each company is going to have a wide variety of different procedures. Some are going to have more information. Some are going to have less. Key is you're going to have to use some judgment. There's going to be some subjectivity involved to make sure, does this make sense? It should at least adhere to the requirements of the model, but there's a lot of subjectivity involved. And so again, as you learn more and more about annuities, as Terry and I have through the years, you get a little smarter, and it's nice to have a comparison of other forms we've seen from company to company. Some of the best, and some ones we'd say these are great best practices, and some of the areas where we'd say we got some work to do here, or we'd recommend some changes. You know, another red flag involves consumers with low liquidity. In essence here, the producer should avoid tying up all the consumer's assets in an annuity. A good recommendation by the producer, excuse me, leaves the consumer with sufficient liquidity in case of an unexpected emergency or expense. You know, maybe the consumer has a health issue, home repair that comes up that just they weren't planned for, making sure that the consumer has ability to access some other funds to pay for those type of expenses. We've seen situations where it seems, man, they're tying up a lot of those assets. How would they pay for that? The annuity file should contain sufficient documentation to explain those type of situations. We've seen situation of unclear source of funds. What does that mean? We don't know where the money's coming from. Where is the money coming to purchase this annuity? We've seen situations where it might be inconsistent. Well, in one part of the file, it says the money might be coming from a 401k rollover. Another part of the file, it's a check. Well, that's interesting. What happened there? Is it cash? Is it coming from a bank? Is it coming from a rollover? We don't know. It's just unclear or inconsistent. We've seen situations where the consumer has had very little investment experience, but the product that is purchased seems to be fairly complex. Maybe it's a variable annuity or just an indexed annuity with multiple options that just seems a little more complex based on the consumer's profile information, which indicated they had very little investment experience. We've seen situations where a consumer has just low income to expense ratio. Well, what does that really mean? Well, it means how much money do they have each month to set aside to say, hey, can I pay for a little bit more of something if I tie up all my annuities? How much more do I have to cover? And again, as consumers hit some of that retirement age, oftentimes their income starts to decrease, and so that should be planned for as part of the examination or as part of the review of that file in an examination. Well, how is this consumer going to be impacted 3-5 years from now, maybe when they retire, 10, 15 years from now? Just something to think about as we look through examinations. Another key thing, again, and we wanted to cover this again because we think it's just critical, relates to annuity replacements. Documentation is key, and Terry did a great job of talking about some of the companies and how oftentimes the companies require additional forms to be completed when a replacement of an annuity is involved. And that best practice where we've seen a side-by-side comparison that just shows, okay, what is the existing product? What is the proposed product? What is the interest rate on both of them? What riders did each one have? What are the interest crediting options? All that kind of stuff. What's the surrender charge period? Are we out of one and we got to start a new one over for the next, say, 10 years? Those things are very helpful in that side-by-side comparison to really have a good understanding of the replacement and is it in the best interest. As examiners, we must ask ourselves, is the annuity file documentation, does it cover this type of thing? It's been said earlier in the presentation, I'll say it again, huge red flag, high surrender charges or fees. Keep in mind there's no specific percentage about how many companies establish, but some companies establish, say, 5%. If it's over 5% of the cash value of charge, perhaps those things need to go through an escalated review process. And again, just because there is a surrender fee doesn't necessarily mean the annuity is not a good choice. It just means we need to have that good documentation. It may be a perfect explanation that the new annuity, all the benefits outweigh keeping an existing annuity, even with the surrender fees. But again, documentation is key. We've seen situations where the experience level of the personnel reviewing the annuity applications for suitability and reviewing in the new business area is just not as strong. And so in these situations, it's important to understand who's reviewing the applications at home office. If there's a lot of turnover in a department such as new business, are they trained appropriately to catch some things? These producers they're sophisticated. They've been in the business, many of them, for a lot of years. They're able to produce documentation at times that we've seen that sounds really good, but if you peel back a little further, you might have noticed they forgot or conveniently not included some key things in a new business file that should be there. And if it's not in there, it can be overlooked by company personnel who just don't have that same level of experience. So it's critical to understand who's reviewing the files at the agency level, at the home office level, wherever it is. One of the other things before moving on to the last slide here, inconsistent or incomplete information regarding replacements. We've seen during an examination where as you keep looking through a sample of replacements, it seemed the same reason was documented the same thing we kept seeing over and over again, simply say better rate. Well, the challenge was there was no additional information in the file showing, well, what was the existing product, what was their interest rate on that versus the new product. It just simply said better rate. Well, that's a very good reason for a replacement, better rate, but there's just not enough documentation there to understand, is that true? We just didn't feel comfortable with that type of documentation. All right. I know we're almost getting to the top of the hour here, so thanks for your patience. Lastly, as examiners, we must pay special attention to the supervision systems that companies have regarding annuities. We've spoke a lot about documentation. The model includes some high-level information regarding supervision systems, but it doesn't give a lot of details. So companies, you're going to see a lot of different ways companies supervise their producers and supervise annuity transactions. We thought we'd include, again, some best practice examples of supervisory processes we've seen in our experience based on our reviewing companies and prior lives at insurance carriers. So first up, companies should have clear policies and procedures on the review and approval of annuities. I talked about that. They can have you can see a lot of different things, but we need to have just clear policies and procedures that have been updated, and that many companies have an escalation process, again, that certain annuities go through a higher level review. And this is an area where, again, you can obtain the policies and procedures. You can, as an examiner, you can test that the escalation process is working by sampling and understanding, hey, if this policy should have been flagged for escalation, did it go there? Again, a great way. And again, just understanding the maturity level of a company's suitability review process. Have their procedures been updated very frequently? Are they tracking cases, as Terry mentioned earlier, that were declined or something like that? What's the analysis and trending? I mean, it can get into culture of a company. You can tell a lot by looking at their policies, procedures, looking at, are they really doing a good job digging in on their producers, their agencies, their transactions, those kind of things. Examiners should also request and review training materials to ensure the materials include the new topics, as well as that are applicable to the best interest obligations. And finally, I think we can always understand the controls the company has in place regarding, when can a producer sell an annuity? Do they have to have the required training? What system does it stop them from submitting business unless they've done, the required training, etc. Terry, I know we're getting close to the top of the hour, so before we talk about anything else, let me go over polling question number 5 real quick, because I know people got to jump off. So here we go, polling question number 5. All the following items may be considered a red flag when reviewing suitability, except A, consumer will incur a 9% surrender charge. B, consumer is 81 years old and recommending a deferred annuity with a 10-year surrender period. C, the consumer has liquid assets of $100,000 reserved in case of emergencies. Or D, consumer has very little experience and the producer is recommending a complex variable annuity. Again, click the button and hit submit. Let's see what we got. All right, the correct answer here that we would go with, again, there's always some subjectivity, is C. The consumer has liquid assets of $100,000 reserved in case of emergency. I see, another answer around the 81-year-old, sample B. In this case, it may not necessarily be a red flag or a bad sale, but it's something that should be questioned to understand, hey, the consumer is going to be, understanding that they're going to be tying up some money for the next 10 years as they age. And just something to consider and make sure there's adequate documentation there. All right, guys. Well, we talked about questions that we might have some time at the end. I'm going to say that we're running low on that time, but we do have, I've seen some Q&A things coming through. And so our goal here is to, we can reach back out to you guys individually and answer those questions. But I do just want to thank you guys as we approach the top of the hour for joining today. We covered a lot of information on the model and just best practices in general, and we hope you guys take away with a better understanding of the best interest standard, the 4 obligations that we talked about, and just some of the new requirements regarding training and supervision, and just what to look out for in examination. So it's been a privilege spending some time with you guys today on the phone. I really appreciate it. What I'm going to do is turn it back over to Allison to wrap up the presentation here.
All right. A few reminders before we conclude. Please take a moment to complete the attendee survey by following the link in the resource list to the right of your screen. We will respond to all questions via email following today's event. We appreciate you joining us, and thank you for participating in today's program.